Have you ever wondered how interest rate changes can affect your finances, and more importantly, what moves you should make when they do? Whether rates are rising or falling, interest rate fluctuations are a big deal when it comes to managing your money effectively. In 2026, understanding how to optimize your savings and minimize debt costs is crucial, especially as the economic landscape continues to shift. In today's video, we'll be discussing 5 smart moves that will help you protect your financial health when interest rates change. These moves can make a huge difference in how your money works for you, so stick with us to learn how to navigate the changes like a pro. Let's dive in. 1. Refinance high-interest debt. The first smart move you should make when interest rates change is to refinance high-interest debt. So, how do you know when it's the right time? Let's break it down. If interest rates are dropping, this is your opportunity to refinance loans like credit card balances, student loans, or adjustable-rate mortgages, ARMs. Refinancing these loans into fixed-rate products helps lock in lower payments for the future. For example, if you're paying high interest rates on a credit card, refinancing it into a low-rate personal loan can save you a significant amount over time. It's about reducing how much you're paying on debt, which directly boosts your savings. Now, if rates are rising, it's time to act fast. You'll want to prioritize paying down high-interest debt before it gets more expensive. Every month you delay, your interest charges continue to climb. So, focus on eliminating credit card debt or paying down your variable rate loans. This prevents the additional burden of increasing debt costs when rates continue to climb, saving you more in the long term. By being proactive and adjusting your approach to debt as interest rates change, you keep more of your money in your pocket, rather than losing it to high interest payments. The key is to refinance quickly when rates drop and pay down your debt aggressively when rates rise. Both strategies work hand in hand to protect your finances from the unpredictable swings in the economy. 2. Shift cash to high-yield savings or CDs. When interest rates are in flux, how should you manage your savings? The answer depends on whether rates are going up or down. If interest rates are rising, immediately look for better places to park your cash. One of the smartest moves is to switch your money to high-yield savings accounts, HYSAs, which typically offer much better rates than regular savings accounts at traditional banks. The best part? Your money stays safe and liquid while earning better returns than it would in a low-interest account. For instance, while most traditional savings accounts offer less than 1% interest, HYSAs can provide returns in the range of 2% or higher, depending on the bank. The difference in interest rates can add up over time, and with a high-yield savings account, you can rest easy knowing your money is not only safe but growing at a faster rate. This is a great move if you are looking to earn more without taking on more risk. But what happens when rates are falling? Here's where you need to act before rates drop even further. Consider locking in certificates of deposit, CDs, which offer higher interest rates than traditional savings accounts, especially when rates are relatively high. A 1-year CD, for example, lets you lock in a rate before the market adjusts, ensuring your savings continue to grow at a better pace. While HYSAs are great for flexibility, CDs offer guaranteed returns over the long term, making them an excellent choice when you want to secure your money against falling rates. Both options help you take advantage of current rates and maximize the growth of your cash, no matter where interest rates are headed. By adjusting your savings strategy to match the changing interest rate environment, you're ensuring your cash is working as hard as it can for you. Whether you're using HYSAs for short-term savings or CDs for longer-term goals, you're optimizing your financial strategy for success. 3. Rebalance your investment portfolio. When interest rates change, so does the market landscape for investments. It's crucial to rebalance your portfolio to stay aligned with your financial goals and the market conditions. If interest rates are falling, growth stocks and technology companies tend to perform well because these businesses thrive in low-interest environments. Bonds also get a boost, particularly long-duration bonds, which become more attractive as rates drop. In this case, you may want to increase exposure to growth stocks and long-term bonds, taking advantage of a favorable investment environment. For example, when rates are low, technology companies, especially those in artificial intelligence, cloud computing, or green energy, become more attractive to investors. These companies tend to grow quickly and can significantly outperform the market when borrowing costs are low. By focusing on sectors that benefit from low rates, you can position your portfolio for higher returns. On the flip side, if interest rates are rising, It's wise to reduce your exposure to long-term bonds because their value decreases as interest rates go up. Instead, shift to short-term bonds or floating-rate bonds, which are less sensitive to rising rates and can provide more stability in your portfolio. Rebalancing your investments means keeping an eye on the bigger picture, adjusting your portfolio to match the economic environment and capitalizing on new opportunities. Whether you're focusing on growth stocks during a period of falling rates or moving into more stable assets when rates rise, the key is to stay flexible and adjust your strategy accordingly. 4. Adjust your strategy for large purchases. When it comes to big purchases like a home or a car, interest rates have a huge impact on your financing options. So, what do you do when rates change? If interest rates are low, borrowing becomes much more affordable. This is the perfect time to make a big purchase, whether that's securing a mortgage for your dream home or financing a new car. When rates are low, you can lock in lower monthly payments, which makes your large purchases more manageable in the long term. For example, if mortgage rates drop by even 1%, you could save thousands of dollars over the life of the loan. Lower rates mean that your monthly payment is smaller, which gives you more flexibility in your budget. So, when rates are favorable, it's wise to consider locking in those lower rates for long-term savings. But what if rates are high? In this case, it's better to hold off on major purchases or delay the decision to buy, especially if you can wait for more favorable conditions. If you absolutely need to make a purchase, one trick is to ask the seller to offer a temporary rate buydown. This means the seller covers the cost of lowering your interest rate for the first few years of your loan, helping you ease into the higher costs. By adjusting your purchase strategy to the current interest rate environment, you can maximize your financial flexibility and minimize the cost of borrowing. Whether you're seizing the opportunity to purchase when rates are low or being strategic about timing your big purchases, you can optimize your budget and make smarter financial decisions. 5. Optimize asset allocation and lock in rates. Regardless of whether interest rates are rising or falling, it's essential to ensure that your investments are aligned with your long-term financial goals. One way to do this is by optimizing your asset allocation. For example, if you're planning a large expense in the near future, say, in 2027, you can take advantage of a one-year CD to lock in a favorable interest rate now before rates potentially drop further. This allows you to safeguard your funds in a low-risk, high-return vehicle that will help you achieve your financial target without exposing your savings to volatility. Additionally, if you're thinking about retirement, consider using a strategy called the bucket strategy. This approach involves keeping cash for near-term needs in safer, high-yield accounts, like CDs or HYSAs, while investing your long-term money in stocks or bonds. This way, you can secure immediate funds for upcoming expenses while still allowing your long-term investments to grow over time. By optimizing asset allocation, you're making sure your money is working hard for you, regardless of the direction of interest rates. Whether you're using safe, short-term assets for near-term goals or investing in long-term growth opportunities, this strategy helps you balance risk and reward, keeping your finances on track for the future. So, there you have it. 5 smart moves to make when interest rates change. Whether it's refinancing debt, shifting cash to higher-yielding accounts, or rebalancing your investment portfolio, these strategies can help you stay in control of your finances no matter how the market moves. If you found these tips useful, don't forget to like, share, and subscribe to our channel for more insightful financial strategies. By staying proactive and informed, you can weather any storm and make your money work for you. Thanks for watching, and I'll see you in the next video.